All right, let's dive right into this explainer. Today, we're putting Graham Corporation through the ultimate fundamental stress test. We're acting as expert investment analysts, running this stock through the strict, time-tested lenses of Warren Buffett, Peter Lynch, and Benjamin Graham, alongside some rigorous DCF and alternative modeling. We have a ton of data to unpack, so let's get to it.
Here's our roadmap for today. We'll kick things off with a company snapshot in the Buffett lens, move on to growth via Peter Lynch, check the value with Ben Graham, run a DCF analysis, look at some alternative models, and finally, wrap it all up with our synthesis and final verdict.
All right, starting right off with Section 1, our snapshot in the Buffett lens.
So let's establish exactly what we're looking at here. Graham Corporation, trading at $108.15 a share with a market cap of roughly $1.25 billion. They're a mission-critical manufacturer for the defense, space, and energy industries, and they just reported a record fiscal 2026 revenue of $245.3 million. That's up 17% year over year, with fully diluted earnings per share coming in at $1.12.
Now, the million-dollar question, literally, does this industrial player meet Warren Buffett's notoriously strict criteria for a wonderful company at a fair price? Let's run the numbers through his framework.
What's really fascinating here is that the business itself actually exhibits several Buffett-approved traits. Their economic moat, it's rock solid. They are a global leader in highly specialized defense and space fluid technologies, backed by a massive $532 million backlog. Debt is extremely manageable, too, sitting at only about $13 million long-term. Plus, management is highly transparent, aiming for over a 20% return on invested capital. And throwing a $50 million strategic investment from T. Rowe Price into the mix definitely confirms institutional confidence. But here's the catch. When we divide their $12.5 million in net income by their $140.3 million in stockholders' equity, the return on equity sits around 8.9%. That's a bit light for Buffett's 15% ideal. Furthermore, paying over 96 times earnings, that offers absolutely zero margin of safety. So bottom line for Buffett, he'd probably appreciate the business, but he would categorically reject the current price.
Moving on to Section 2, growth through the Lynch lens.
Let's shift gears to Peter Lynch, who loves categorizing stocks by their growth story to hunt down those elusive multi-baggers. Given their record $532.6 million backlog and that 17% revenue growth, Lynch might actually classify Graham Corporation as a stalwart that is rapidly transforming into a fast grower. This is heavily fueled by surging defense contracts and their recent FlakTech acquisition. Lynch absolutely loves a strong balance sheet, and he'd be thrilled by the historically low institutional ownership giving way to that smart money pipe investment.
But, well, here is the glaring problem for our Lynch analysis: the PEG ratio. Lynch popularized dividing the price-to-earnings ratio by the earnings growth rate to spot value. So if we take the current PE of roughly 96 and divide it by a highly optimistic forward growth rate of 20%, we get a PEG ratio of 4.8. For Lynch, anything over 1.0 starts getting expensive. 4.8, that's just in the stratosphere.
So the crucial takeaway here is that while Lynch would definitely love the clean balance sheet, the fascinating niche, and those institutional buying signals, he would almost certainly walk away based on that massive premium for growth. It is simply priced for perfection, and you know Lynch prefers growth at a reasonable price.
All right, Section 3, value, looking through the Graham lens.
Let's bring in Benjamin Graham. His checklist for the defensive investor is, frankly, unforgiving. Now, while Graham Corporation passes the adequate size test with its billion-dollar market cap, it basically fails everywhere else. Its current assets of $156.4 million divided by current liabilities of $156.2 million yields a current ratio of just 1.0. That completely fails Graham's strict 2.0 requirement. Plus, the company suspended its continuous dividend back in late 2021. And of course, its sky-high earnings multiple of 96 shatters Graham's moderate PE limit of 15.
To really hammer this home, let's calculate Graham's famous intrinsic value formula. We take the square root of 22.5, multiply it by the EPS of $1.12, and then multiply that by the book value per share. We derive that book value by taking their $140.3 million in equity and dividing by 11.72 million shares, which gives us $11.96. If you run that math, the square root of 301.39, it yields a baseline intrinsic value of exactly $17.36 per share.
And this right here brilliantly illustrates the disconnect in today's market. Graham requires a massive margin of safety, typically a third off the intrinsic value. That means the father of value investing wouldn't even bat an eye at this stock unless it plummeted below $11.50.
Let's move on to Section 4, our DCF valuation analysis.
Taking a more modern, quantitative approach, let's forecast intrinsic value based on future cash generation. Because we lack explicit forward free cash flow estimates in the source data, we've carefully calculated an owner earnings proxy. We take the $12.5 million in net income, add back $7.8 million in depreciation and amortization, and subtract $15.8 million in capital expenditures. That leaves us with a modest base of $4.5 million. From there, we'll assume a pretty aggressive 15% growth rate for 5 years to reflect that massive order backlog, a perpetual terminal growth rate of 3%, and we'll discount it all back to the present using a standard 10% weighted average cost of capital.
Running our sensitivity table on WACC and terminal growth rates, the results are honestly quite telling. At our base case of a 10% discount rate and 3% terminal growth, the fair value sits at just $19.30. Even in our most wildly optimistic scenario, dropping the discount rate to 8% and bumping terminal growth to 4%, the fair value only stretches to about $35 per share.
Up next is Section 5, Alternative Valuation Models. Just to ensure our analysis is airtight and we aren't missing some hidden value, let's cross-reference 2 alternative valuation models to see if we can somehow justify that current price tag. We're going to weigh the classic dividend discount model against an operational multiple based on the reported $26 million in adjusted EBITDA. So the dividend discount model is super simple here. Since Graham suspended its 11-cent quarterly dividend in 2021 to retain capital, the DDM yields an equity value of exactly 0. On the flip side, if we assign a generous 15 times multiple to their $26 million in adjusted EBITDA, we get an enterprise value of $390 million. Adjusting for cash and debt, that gets us an equity value of roughly $383 million, which translates to just under $33 per share.
Finally, we arrive at Section 6, Synthesis and Final Verdict.
Okay, we have rigorously crunched the numbers through 5 distinct frameworks. Looking at how this builds our final picture, every single valuation methodology places the intrinsic fair value of Graham Corporation drastically below its current trading price of $108.15. Whether we look at Ben Graham's 1736 intrinsic value, our DCF at 1930, or our EV to EBITDA model at 3273, the market is currently pricing in decades of absolutely flawless, uninterrupted hypergrowth.
We really have to separate the business from the stock here. The business itself, it is executing flawlessly. They have an incredible $532 million backlog, soaring defense demand, and smart capital backing them up. But the investment risk lies entirely in the valuation. With an extreme PE of 96, a modest 8.9% return on equity, and no dividend to act as a floor, investors are paying entirely for future potential, leaving 0 room for error.
Blending the insights of these legendary investors, the verdict is crystal clear. This is a wonderful business, but a highly speculative stock at current prices. From a pure fundamental analysis standpoint, our final verdict at $108.15 is a firm sell or avoid.
I'll leave you with this final thought to ponder. If Graham Corporation's underlying execution remains flawless and they keep beating earnings, at what exact price point would the margin of safety finally trigger a buy for your portfolio? Is it $40? $30? That is the exact discipline fundamental investors must master. Thanks for joining me on this explainer, and as always, keep doing your homework.